Hi, I'm Mitch Slater. I've been a financial advisor and wealth manager for 25 years.
Hello, I'm Ben Banks. I'm 17 years old from Charlotte, North Carolina, and I swing trade equities.
So Ben, there are a lot of great investment minds over the years. We talked about Warren Buffett and Mr. Market. One that I've followed for many years is a guy named Peter Lynch, who you might not know. Peter Lynch was the manager of the Fidelity Magellan Fund, which was the single largest mutual fund for years and years until Bill Gross's PIMCO Bond Opportunity Fund took over. But something that Peter Lynch told me on a financial radio show that I hosted a few years back has always stuck with me, and I'd like to get your opinion of that. Peter Lynch has this great quote talking about it's not about timing the market, it's your time in the market. In other words, it doesn't matter about trying to time when you're going to get in and out, but if you leave your money for the long run, you'll do very well. What do you think about that?
Well, I think it is possible to time the market, and if you don't time the market, you won't reach that full potential that the market's providing you. If you learn how to time the market and time the trends and time the entries, you can really maximize your profits and your time in the market. When you're just throwing money at the market, you're just throwing it away. It could be in a downtrend, it could be correcting, and you don't want to be putting money in when the price is going down. You'd rather be putting it in as the price is, gaining momentum and rising.
But when the reality is that the streets are littered with people that have tried to time the market, that have tried and failed. For those people that got in the real estate market in June of 2007 and felt like this was the best time to be buying real estate, and then obviously that bubble erupted. So you're saying that through technical analysis, you can find those trends. You can be ahead of the curve.
Well, not necessarily ahead of the curve, but just be able to recognize the patterns to participate and enter the market when it's correct and the right time to put money into the market.
Mm-hmm. Well, and that's really what we've been talking about today. There's two sides to every coin, and I think it's great. Most important thing to take away from today is that here's a 17-year-old who isn't getting ready for the prom today, isn't out playing baseball or softball, isn't driving his new car. He's taking the time to come to New York City to learn more about his craft that he's developed, a technical analysis, but it's financial literacy at its core. It's taking the time to learn about money at a young age, because if we had more people doing that, we probably wouldn't have had the bubble that we had in 2008. It's important that people learn that, and they learn that at an early age. So there's probably, what do some of the teachers think at your high school about what you're doing? This has to be a unique situation, seeing someone like you.
Yeah, well, my teachers sure don't like it when I bring out my iPhone and check the quotes, raise a stop, place a trade.
Wait, so you're doing some of this on your phone?
Yes.
How are you doing that?